I'd like to welcome you back to the second session of today's Client Forum for Buyside Week 2017, New York City. We're going to dive into financials and regulation next. I know that is going to get a lot of your attention. A couple of quick reminders. Don't forget to hold on to your badges because particularly tomorrow you'll need them getting into 731 Lexington for the second session. And I also want to, again, promote the app and the question function. As the experts talk and you have a question, fill this out, send it in. The moderators will get them. And if they have time, they will ask questions. Otherwise, we will get back to you as soon as we can with an answer. So, with all that said, let's proceed with the Client Forum.
Ladies and gentlemen, please welcome Bloomberg Intelligence's Nathan Dean.
Thank you, everybody. Pleasure having you here in New York. And wanted to talk today just briefly about what Donald Trump is doing about financial policy and markets. We'll talk a little bit about energy because we have an energy expert on our panel. Just real briefly about my background, I am a government policy analyst with Bloomberg Intelligence Washington Group, part of the government litigation and ESG team. My one rule for this session is that if you have any questions and we don't get it to in the panel, contact us, help on your terminal, call us, IB us. We are here for you. So please don't go back to your office or the trading floor without getting the questions that you seek. We've got two gentlemen here that we're fortunate enough to have come with us. First is Michael Roomberg. I promised him that I would not make a Michael Bloomberg joke, so this is me not promising.
A couple letters and a couple zeros,
yeah.
Otherwise no difference.
I said I'm sure that he's heard this before, but Michael Roomberg is
I also had the opportunity to hear a lot of colleagues repeat what I said on the trading floor in Spanish, in broken Spanish, in the wake of Sandy when the mayor would go on TV every day for those that are local and remember that. But yes, not something I've never heard before.
So I kept my promise. I didn't make the joke. So Michael Roomberg is the co-lead portfolio manager for Drillbit to Burner Tip. The ticker symbol is DBBDX. As the mouthful of a name implies, the portfolio makes equity investments across the entirety of the entire energy value chain. The portfolio has a particular emphasis on natural gas. We'll talk about that a little bit. He's with Miller Howard, at the... in addition to more of the traditional energy companies, which Michael believes provides the opportunity and to manage more effectively through what seems like shorter and shorter energy cycles, the portfolio is purely North American focused. Prior to joining Miller Howard, he counted Miller Howard as a client, as a sell side at various banks and covered various sectors, including industrials, energy, and water. He's a CFA and has earned his MBA at Georgetown and with honors. To my right, we have Henry Peabody. He is the portfolio manager with Eaton Vance Management in Boston. Manages retail and institutional client assets in multi-sector strategies, which follows global value-oriented approach with flexibility to invest across fixed income, equity, currency markets, with a focus on total return. He has an undergraduate degree from Trinity College and an MBA from Boston College and is also a CFA holder. I asked both gentlemen to give me an icebreaker before just to set the stage. Michael is from Philly, Henry is from Boston. They're both appropriate Philly and Boston sports fans, so I told them kudos to coming into the belly of the beast, specifically into New York to address today's session. Now, what I first wanted to start off with was just some general thoughts about President Trump and his impact so far. You both have differing sectors, different portfolios they manage, but any thoughts for our audience today right now on the markets since Donald Trump's inauguration? The Dow Jones in November 2016 was like 17,898. The day of the election, as of this morning, it was 21,136. Any surprises, anything that you thought was going to happen or not happen, but just could you give us a 4-month look back, Henry?
So I'm not going to tweet this answer, but surprises from the Trump administration. Many, too many to count probably. But I think that one of the big things to think about is essentially a transfer of risk after the election. And what we had was a new, perhaps weak hands taking over risk in the risk markets as we rallied after the election. And that rally was very short-lived. We started to price out Trump's impact on policy or the markets almost immediately after the election. depending on sector performance, how you look at it, bond proxies started doing well. And also you had, for example, the 2-year, 10-year spread come down, the 10-year rate trade off, the dollar trade off almost immediately. So the Trump impact was short-lived. That's not to say it can't be revived, but it seemed fairly short-lived. And now we have a situation in which rates are questioning, the rates market are really questioning the ability for any policy to get through, which would impact the Fed. So we're setting up for a fairly interesting second half of the year as we get to resolve the rates versus risk market question, which I think will be fairly interesting.
Cool.
I would just add on the energy side that we had a kind of a junk-led beta rally in the wake of the election. Energy sector jumped through the next 6 weeks following the election about 15%, and since then it's down about 20% from the high water mark. Obviously that's much more crude and macro-driven than it is policy-driven. There really hasn't been much of a change with respect to policies. Legislation's been stagnating. One of the sectors that really we saw as a firm a lot of investor interest was the engineering and construction sector, on the premise that all these companies were going to build a 2,000-mile wall and wouldn't have to pay any taxes on the earnings that they generated from that. Some of those companies were the highest flyers towards the end of the year. And now, having just checked this morning, have mostly pretty much retraced all the gains post-election. So I think we're kind of back to where we started in a way of two candidates, one of whom was known, the other of whom is not known and probably is still not known. And I think that's what markets are figuring out, both on the energy side and on the broader
So Henry, you mentioned, this Trump effect could come back. What are some of the bigger risks or opportunities that you see stemming from the policy arena today as we try and look forward to the rest of the year?
I think the tax issue is probably one of the biggest, and we can talk about infrastructure. You'd be better suited than me to talk about that. But we have a market in which deep-pocketed and price-insensitive buyers have been buying the government bond market for the past several years between reserve managers and quantitative easing. And if we have some form of tax reform come through, depending on if it's funded or not, and we've seen a wide range of outcomes from a couple of trillion over 10 to 6+ over 10 years, and depending on the funding status of that, the funding status is really the key question in our markets, and that is, if it's unfunded, you have, pick a number, 200 to 500, 600 billion in net treasury supply coming into the market when the collective we, are price makers for the first time in ages. And with that, the risk is for dramatically higher rates in the grand scheme of recent experience. If that tax cut or reform is viewed as effective and to encourage growth, then that is even that effect would be amplified. So the market is setting up for some fireworks in the next probably 6 to 12 months. And there's positioning is potentially very wrong-footed, we believe. So that should lead to some fairly significant increase in volatility. Credit spreads could be impacted. But ultimately, for long-term investors, that's a great opportunity. So if we can get a better growth environment with this tax situation at higher nominal yields, we're in, I think, a pretty good spot.
Michael?
Yeah, I mean, I would just add on the energy side, and this is probably something that you won't hear from too many energy managers, but I think it speaks to sort of the tail risks that are existent with respect to regulation. The portfolio I manage is mainly focused on shale, oil, and gas, predominantly natural gas. And when we think about this technology, it's a disruptive technology, it's a deflationary technology. It has gained widespread bipartisan acceptance as a consequence of the fact that it has widespread popular support. Folks like cheaper energy, despite some of the hysterics around the issue. There's been over 200,000 wells that have been fracked in the United States since the 1950s, and as long as there's good regulation in place, that can be done safely. If we look back to the wake of the election, there was a lot of high-fiving amongst various energy executives that I knew They now had a friend in Washington, quote unquote. But that can cut both ways. Good regulation is important. And if I look at the example of Oklahoma, most people here have probably heard in the news that there are a lot of earthquakes in Oklahoma as a consequence of disposal of wastewater from shale drilling. And this is a known scientific issue. If you have a fault that's underground and you dispose large volumes of water into that fault, you could run a risk of generating an earthquake. In many states, they have regulations that require setbacks away from those disposal locations, and they hadn't had those in Oklahoma for a long period of time. So if those regulations that exist in other states are pressured to be rolled back, in states where there's perhaps a bigger population relative to the size of the indigenous oil and gas industry, such as even Texas or Ohio or Pennsylvania, that could run the risk of an accident and a turn in popular perception towards the industry. So I kind of offer that up as something that I think people don't think about, but is an important aspect of regulation that we sort of benefit from a Goldilocks regulation here in the United States. And I think, at the end of the day, that's going to be the prevailing wisdom in this administration too.
So
Can I jump in
please.
briefly? I think one more thing to think about, and I think we may explore this a little bit later. And there was a panel on geopolitics earlier, but let's consider a little bit recent maneuvers from the administration with respect to the U.S. influence on global politics and how that could impact the support of the dollar globally. We'll explore this more, but between backing out of TPP, between NATO, Europe, and a stronger Europe, the use of the dollar as reserve currency can definitely be debated, and this isn't an issue for today, but I would just urge everyone to think about this in the longer term.
Let's go there. I mean, the America First policy, which has, it starts at the White House and it is moving down into the regulatory agencies, this idea that anything we put out there has to keep America first in mind. Does this pullback from the U.S. as a global leader impact your portfolio? Henry, does this make emerging markets more attractive? Michael, I'll ask you about the Paris Accord and opportunities for coal, but maybe Henry, if you want to just give us your thoughts, is there new opportunities coming out of this thinking?
Well, I think this thinking is part of our position. So we have a roughly 25 to 30% position in non-dollar credit, LATAM, Asia, for the most part, with some DM. The thinking is that it's two-pronged, and one is that growth essentially, we're pricing out Trump, and we all are fairly well aware of that, but growth was reasonably good going into the election. It remains reasonably good today between leading indicators, employment, take your pick. So global growth converging higher with rates moving up globally is not a good environment for the dollar. It's very good for other currencies. So that's where we sort of start from. We then think about reform stories in Latin America, for example. But then again, this idea of U.S. isolationism, and I say it with a small I guess, is not a positive for the dollar. It is Asia, the gap is being filled by China, which is all well and good, and it's something we're aware of. Europe is getting stronger. The French election was a really big deal, and Germany's being pulled more towards a pro-European stance. So Europe is really becoming a stronger entity, a stronger institution, at least for the near term. And I think we as Americans are generally biased against that view. I think we think of it as a currency union and little else. So that keeps a bit of a lid on the euro, but we're seeing that unwind over the past few weeks. U.S. influence being reduced is essentially a negative for the dollar, as our influence in geopolitics, the financial system, defense policy is reduced. The use of a currency to settle trade finance is marginally reduced. So that is a positive for the euro. It's a positive, frankly, for China, but that's a longer story. So that ties in with the allocation.
And Michael, when Donald Trump announced they were going to pull out of the Paris Accord, I read some reports from energy analysts saying that it may not be that big of a deal on the coal industry. Can you give us your outlook of this mentality, and does it have an impact?
There's not a single analyst on Wall Street that's changed, even a rounding error of a number in relation to their forecast for the expectations for coal, oil, and gas as a result of pulling out of the agreement. I think, to Henry's point, it is more about a global leadership issue. But speaking to coal, I've said this in the past. At current gas prices, clean coal is a fiction. If there's one plant that's being built right now by Southern Company called the Kemper plant. That plant is 6 years into a 3-year construction project. It's $3 billion over budget. And can't make any money at sub $5 natural gas prices. Well, natural gas prices haven't been above $5 in 10 years. So the wisdom of going back in that direction seems pretty misguided in our opinion. And if you just look at it from a jobs perspective, a policy perspective, there's 3.5 times more people employed in the oil and gas industry than there are in the coal industry. In fact, there's 50,000 people employed in coal. There's about 70,000 employed at Arby's. So, the ranking of coal in the continuum of importance I think is probably going to decline. And if we think about, most of these things most of the decisions are made at the state level. And so, the regulators at the state level all have their own individual objectives, and it's unlikely that they're going to comport with, the federal government's policy. But at the end of the day, I think that no investor is going to put a large capital investment that may have a 7 to 10 year payback period, simple cash on cash return, in a coal plant when you have an administration that at its longest is going to be here for 7 years. So I just don't see that as being a major factor.
So is regulation the answer? Because in the financial regulatory space, for example, Dodd-Frank is not, the chances of Dodd-Frank being impacted or changed by legislation is pretty weak at this point. There is a vote tomorrow on this Financial Choice Act. This is the Dodd-Frank Republican bill, and essentially it's a several hundred page paperweight. I put a note out on Monday, inspired by my 3-year-old daughter, that the Senate is going to put this bill in timeout when it passes the House, because there is this filibuster. So what we tell people, and we're telling our investors and our clients, that Dodd-Frank is going to be weakened via the regulatory process. This is something that's going to take a lot of time, and it's not going to be sexy and exciting. It's just going to take a lot of time, and probably several years for things to actually begin to impact the bank. Is that a similar story over in the energy space? I know FERC has only, I think it's 2 commissioners right now, the Federal Energy Regulatory Commission. What's holding that back?
So FERC is the agency that approves pipeline projects, and like many areas of the administration that had kind of suffered from a delay in appointments, and I'm not an expert on the way that the bureaucracy works, but I'm under the impression that that's the case. At least in the FERC, there were 2 commissioners that have been appointed, not yet approved, I believe the beginning of May. And one of those gentlemen, Robert Powelson, who's been a longtime commissioner of the Pennsylvania Public Utility Commission, which regulates water, electric, and gas utilities in the state of Pennsylvania, is a really thoughtful thinker in the space, and somebody who I think will be a very powerful and positive force for energy pipeline permitting. But it's important to remember, as we talk about infrastructure and as it relates to energy versus civil infrastructure, energy infrastructure is mainly privately owned and operated. It also enjoys great tax benefits in the form of the master limited partnership structure, which is very conducive to funneling capital into these types of projects. If anything, today we have an excess of infrastructure in a lot of these basins that there was a period of time where there was a shortage because we had oil production that doubled in 5 years and natural gas production that rose 30% in 6 years. But that's now largely caught up because of the appealing structure of the private ownership of these assets. Maybe that's something on the policy side that folks could look at, a similar structure, and obviously you have to get over the initial pushback to private ownership of public civil infrastructure assets, but that's why I'm not a policymaker.
So Henry, taking us back to tax reform and this idea of economic growth, our Secretary of the Treasury, Stephen Mnuchin, has said that he wants tax reform. Originally had wanted it done by August. Several policymakers are saying maybe the end of the year. Some people have even said middle of next year. And they said that the tax reform is the vehicle that the U.S. is going to need to get 3% growth, 4% growth if you're the president. How important is this tax reform debate? Do the fundamentals tell you that the economy is going to move without it? Does it need it? Because I have a lot of clients tell me that tax reform is probably their most important issue that they're following right now in Washington. I'd love to hear your thoughts on this.
Well, I think there are a couple of fairly large-scale and longer-term trends that are in the process of shifting that do support growth absent of tax reform. And they are the aging of infrastructure, the aging of fixed assets, and the need to replace them with a fairly substantial CapEx cycle. And the other is baby boomers beginning to draw down retirement, beginning to spend, pushing the savings rate potentially lower. So I think that those set the stage for it. Tax reform in and of itself, depends on its format. Does it pull forward growth or does it actually add to productivity? Because productivity is really the issue that, we all read about it. We all know that we face it. We've been running sub 1% productivity or whatever it is for ages. And the question is do we actually invest in plant and equipment that adds to productivity? Because absent that productivity shift, absent some mammoth increase in the fertility rate or change in immigration policy, which is pretty unlikely, it's hard to imagine a 3-4% number. But I think if we can talk about expensing CapEx immediately, which was part of the discussion, and if we can talk about bringing in spending that adds to productivity, then it's a real conversation. All that said, the underlying economy, if you can pro forma out the administration, for lack of a better phrase, is still fairly good. So certainly better than warrants a 2.1% 10-year note.
And Henry, just to follow up on, something I wanted to ask you from our regulatory discussion is that, something we hear in the financial space all the time is about this liquidity issue or lack of liquidity. Under the Obama administration, I used to classify it as a perfect New York versus Washington fight. You would have banks come down to Washington and say there's a liquidity issue, and the response from the regulators and from Democrats was, we just don't see it. Some have said that, Donald Trump doesn't view financial regulation as a high topic or a high priority topic. That's our view. He didn't win Ohio by saying, I'm going to go out and tackle corporate bond market liquidity. But, it
was to revise the air traffic control system. That was the swing vote.
So, the Volcker Rule has been criticized for banks for this liquidity issue. What are you seeing in terms of liquidity? And specifically, has policy impacted the bond market? And how does it, where do you see it going from there?
It definitely has. And for anyone here in the credit markets, you see it as well. And, the good old days were when you had some sort of event and spreads would widen and the street would take down a whole bunch of bonds and you'd sort through them and you'd find ones you want to own and things would come back in a fairly orderly fashion and they would make their pound of flesh in the process, but they were part of the system. And I don't know what the right answer is, but I think in its current state you're seeing volumes certainly hampered and it's fed into the new issue beast. And what we're seeing is names that rarely trade will all of a sudden pick up in volume around when a new issue comes. And new issue is used as a way to establish a position much more than secondary trading. Does that embolden leverage? Perhaps, along with the focus on passive and index-focused strategies. So that's certainly something to think about. For us, we're biased. I think that the lack of trading in secondary markets and lack of liquidity is actually a fairly significant advantage for those who are willing to use it in their favor, but there aren't very many who are. So I think the liquidity has certainly been hampered. Trading venues from the electronic side, and I'm not a trader, so I'd give me a little room on this, but it's fairly fragmented. A number of systems, some will last a few months before going away because nobody uses them. It's very hard to centralize trading as it has in the past, directed at the street. Again, I don't know if that's the right answer insofar as banks taking risk and putting risk in the system, but liquidity is certainly affected.
Do you think people want a solution now, or are they okay with a solution coming down the line? And the reason why I bring this up is because if you look at the Volcker Rule, and it's a 5-agency rule, so it's the Fed, FDIC, OCC, CFTC, and SEC. For the Volcker Rule...
Say that 5 times fast.
I can't. So to roll back the Volcker Rule effectively, though, you need all 5 agencies to agree. And the OCC has made some statements, because it's now led by a Republican leader, it's made statements that it's going to unilaterally weaken the Volcker Rule without the Fed's permission. And because banks are under the Fed's jurisdiction, no compliance officer is going to allow their front office to start prop trading until the Fed signs off. And Janet Yellen is, her term is up in February of 2018, and we'll talk about that in a minute. So, is there this anticipation that solutions are going to be coming soon? Or do people realize that it's going to take 2 to 3 years for things to come down the line?
I don't think anyone is changing their business model or expectation based on regulations changing soon. I don't think that's really a real conversation at this point. So that's good.
So, Michael, is that the same story in the energy space? I mean, I've had several energy analysts, and I'm not an energy analyst, but and just talking to them say that if you compare Donald Trump to Barack Obama, you may actually come out with a similar story of how things have worked so far. Is Donald Trump answering the rhetoric with actual policy goal, or is he actually trying to deliver on policies that he's put in the campaign?
I think it's a great question. The shale revolution occurred under Obama. It didn't happen because of Obama, but it didn't happen in spite of him either. Today we have an abundance of oil and gas, a glut of oil and gas, and prices remain low. I think the best thing that the administration could do is pursue policies that increase the demand for these products. One of the things that we've heard a little bit about, without any real specifics yet, but is encouraging, is LNG exports. There is no better way for Donald Trump to deliver on his dual campaign mandates of creating good, skilled labor jobs and narrowing the trade deficit than pursuing additional LNG export agreements with places like China, India, Korea, and Japan. China and India are going to double their imports of LNG over the next 5 years. There are currently 6 LNG export facilities that are under construction in the United States. Each of these is a multi-billion-dollar project. There's about 3,000 construction jobs directly on site. And if you consider the entire value chain that supplies that facility, whether it's the pipelines or the drillers in the field or the regulatory folks or all the way down to the country store that has to serve the workers out in the field, all told, one of these facilities will generate about 10,000 jobs. And so this is something that is incredibly potent from that perspective. It's one of the few things the United States manufactures that's cost competitive with the rest of the world. So I think one way to translate some of this protectionist rhetoric and sort of brouhaha at the negotiation table, and obviously Rex Tillerson is aware of this, and Gary Cohn, and certainly Donald Trump, is to talk to these counterparts and say, my entire candidacy was about becoming more equal partners with you in trade. If you would like to avoid or avert a trade dispute, perhaps buying more of our LNG would be a good way to start.
So you mentioned LNG, and I have to ask this question because of it. Do you see Donald Trump playing a role in the Qatar-Saudi Arabia debate? Yeah. Is there a market impact, or several of our analysts have put out notes saying that you should just keep calm and carry on? What are you thinking?
Well, it's a great question. So this is obviously a bit of a Byzantine conflict, and one that I don't think will have a big macro impact. But what it does do is remind LNG buyers that Qatar, which provides 30% of the world's LNG, that diversity of supply and security of supply from various places is equal to or greater in importance than price. The country of Japan, their entire economy would shut down overnight if they had no access to regular LNG imports. So I do think it's something that we can capitalize upon. In terms of that individual conflict, I've seen mixed, kind of media reports about whether, the U.S. is kind of supporting one side versus the other, whether there's legitimate claims or it's, sort of just a historical grievance. The U.S. has 11,000 active service members stationed in Qatar, and I think the world is full, generally speaking, of kindling, and it's best to kind of take the matches away whenever we can as a policy, and hopefully that will, and I say that strictly from a portfolio management standpoint. because I think it's important for risk.
So tomorrow is a very important day in Washington. If you're in Washington and you want to watch the hearing, pretty much every bar is live streaming it and has specials, so I invite you to it. Tomorrow is the testimony
Is
of
Bloomberg having any special?
we will be at our terminals working very hard during that time. So the question I have for you, and this is for both of you, is that when it comes to Donald Trump, FBI, Russia, is it noise or is it something that you're keeping tabs on? Because if you look at the 2017 calendar and where we are for the rest of the year, June and July essentially is going to be the summer of this Russia and FBI. You have August, which is the recess. You have September, government shutdown potentially, the debt ceiling. We'll talk about the debt ceiling in the next question. And then you got the rest of the year. So, we have seen some small volatility moves over prior, issues of like Washington Post or New York Times articles coming out, et cetera. But I just wanted your views on like what do you see in terms of this Russia investigation with Donald Trump? Is it something that you should keep your eyes on?
From a portfolio standpoint, I think one of the things that we've learned over the past several months is that dips are bought and volatility is bought and volatility is pushed lower, and you see these hiccups and they're used as opportunity. I don't mean to paper over this issue in the least bit because I think it has fairly substantial geopolitical alignment, post-World War II implications, certainly Cold War implications, and currency implications. But it's just so hard to put a figure or a number or a trade on what Comey's going to say. It's just so hard. I wish the answer was different, but I think you have to do your best to look past some of this and think about likely outcomes in the next, frankly, 12 to 24 months, because we run the significant risk of getting caught up in a lot of noise that may or may not affect asset prices. Yep. And the risk is that we get caught wrong-footed, and it's very challenging.
Michael, any thoughts?
I think, obviously, it will be interesting to hear what he has to say, but I think what's most important at this point is not what he says and what the outcome of the Robert Mueller investigation is. And I think at the end of the day, the markets will appreciate certainty, regardless of what the outcome is, to kind of move forward and move ahead with it. And, to the extent that that becomes less of a drag on the passing of good legislation, then, I think it would be a positive just to kind of see this resolved quicker rather than later.
So I just mentioned the debt ceiling. One of our top political risks this year is the debt ceiling fight. There's been talk that the debt ceiling could come as soon as the August recess, meaning that Congress would have to deal with it in July. There's been talk that it will come sometime in September when the government shutdown debate. One of our own strategists, Ira Jersey, is going to be putting out his note on when he thinks that's going to happen. If you look at the 2011 debt ceiling fight, S&P downgraded the U.S. debt. There was an 80 basis point drop in the Treasury 10-year. Now, I know that some of it had to deal with the European crisis that was going on. I don't know. But is this something that investors should be interested in? Is this something that you are keeping on your radar as a fixed income investor?
Absolutely, but there's still there's a lot of circus around it. There's a lot of volatility. There's a lot of it's more of a charade than an actual issue, barring something substantive in that we actually delay it or something like that, which I don't think is in the consensus. It certainly isn't our consensus. We're not interest rate timers by any stretch of the imagination. So we, I think, fit in the consensus view that this is something that's going to be resolved. There may be noise around it, which can provide for opportunity for those who are willing to play it. But it's not something that we put in our mainstream thinking. We focus on value and credit and fundamentals, and this isn't part of our thought process to a substantial degree.
Michael, any thoughts?
As an energy investor, I'm not going to go anywhere near that one.
So let's turn to polling and Q&A. I apologize to the Bloomberg team. I should have done this before our session today. So you can see here that, get ready. One of the questions we have is, where is the biggest opportunity for, the question just disappeared. So why don't we just go to Q&A then? So the first question I have for Henry and Michael is are we underestimating the medium longer term risks of the current administration impact, given that almost 75% of the cabinet positions are not appointed, most don't even have a candidate? Given that it is the cabinets that will implement the policies, is this something that that we should be taking more into account?
I would say that, the old saw that markets like kind of gridlock or status quo, I think is a good thing. I think it's an accurate one. And if we look back to the Obama years, it wasn't necessarily that, Obama was the best president for stocks or that he was the worst. It was that there was this sort of stalemate between Obama and Congress, and I think that led to an environment where there was a little bit more of an understanding of the parameters of where we are. With Donald Trump, clearly we're in uncharted territory, and markets have a great ability to not look more than one horizon over. And so certainly there's probably long-term implications of his presidency. I think there's probably even greater long-term implications of the movement that spurred his candidacy and his presidency. And how do you create jobs for people who are inevitably going to be laid off when 5 million truckers and taxi drivers lose their jobs to automated vehicles? These are real serious policy problems that need to be solved. And I think the most encouraging thing for the markets long term, that you'll have thoughtful policymakers that are competent and can think about these issues and how to address them in a way that is least disruptive for society.
I'd go back to the currency issue and geopolitics as one of the main risks that's being underappreciated, and the S&P at highs I don't think factors that in. All that said, it's a very hard event to trade in the short term. I think your point about employment is a real one, and does there need to be a conversation about some sort of universal basic income? I think that's probably something we need to discuss in the next handful of years. And not necessarily enact something, but certainly have the discussion about displaced labor. I think that the market is underappreciating some of the risk, particularly on the geopolitical side. Yeah, I do.
But I think I just want to, and I agree with everything you've said. I also think that the market has a underappreciation for the power of compounding growth over time. And so, there are still plenty of opportunities. There's going to be plenty of opportunities around the automation of vehicles that are going to create great wealth. It's going to change the way that we live, geospatially, in terms of the way we organize our lives. I wouldn't mind commuting an extra 45 minutes if I didn't have to actually operate the vehicle and could work and do email. So I think there is great opportunity and great promise, but also a lot of risks, and that's why having competent leadership is more important than any real ideology.
I would also just add that should we see this movement on the rate front later in the credit cycle, as there is a conversation about the lifting or examination of the 6 times leverage cap in the bank loan market, if you start to see leverage get extended as rates move up, as inflation is moving up, that's sort of when accidents happen. Yep. So just something to consider as a risk.
As an energy manager, I have to make a plug for energy. The rise of autonomous vehicles will actually be one of the biggest net positives for natural gas of anything that could be, and electric vehicles, of anything that could come on the horizon. Because, where does that power come from? It's not going to come from windmills. It's going to come at night when you're sitting in your garage. Mm-hmm. And we'll be commuting longer distances. So I just highlight that because there are opportunities in areas where a lot of people view just risk.
And one of the questions here is directly to that point. They're asking, where is the price of oil headed?
Where is the price of oil? I don't know. Do you know? Look, here's what I think. I think that shale caps the price of oil on a soft basis around $60 a barrel. At that point, you see West Texas, North Dakota, South Texas light up with rigs and push the price back down again. If you are to drill a well, an individual well in the best area of West Texas, the break-even prices are about $35 a barrel. You add in the corporate overhead, and your break-even average company operating in the shale basins is probably requiring about $50 a barrel. In the Middle East, Gulf states, the actual direct cost of production might be only $10 a barrel. But if you add in the cost of keeping peace and stability and all the social governance programs, those countries, very few of them are fiscally sustainable at sub $60 oil indefinitely. And so, frankly, I think one of the biggest bull cases for oil over the longer term is that one or more of these countries is no longer perceived to be a reliable source of supply for the world. Now, OPEC could abandon this agreement. Frankly, they should have kind of finished the job rather than talk about a freeze 18 months ago. I think that would have been more beneficial. But for the cartel, not necessarily for shale. But I do think that they can't sustain another price war. So they're kind of in a position where they've burned through a lot of their rainy day funds. And while there could be volatility between here and there, the long-term bull case for oil, I think, is just that, is that the U.S. is a safe and secure and politically reliable place that will continue to take market share from places abroad.
Sounds good. It looks like we're actually getting to the end of our panel, so please join me in thanking Henry and Michael. Thank you again for your conversation, and it's been a great experience. Great. Thank you.